the Financial Survival Network, helping you to survive and thrive in the new economy. Get our complimentary newsletter at financialsurvivalnetwork.com. This is the Financial Survival Network.
This show is brought to you by Audible. They are the leading provider of spoken audio information and entertainment. You know I'm a huge Audible fan because you can listen to audiobooks whenever and wherever you want. Whether you're at the beach, the gym, or stuck in traffic, there's nothing quite like Audible. Go to audiblepodcast.com/Lutz and sign up today. You are listening to the financialsurvivalnetwork.com. This is Kerry Lutz on 1230 WBZT. Well, it's said that in times of danger, crisis, opportunity arises. Well, certainly with Detroit going belly up and filing bankruptcy and the general jitteriness and fear in the municipal bond market, other opportunities will arise. And right now, I've got someone who's a bit of an expert, Michael Combs, in municipal finance, to talk about it. Michael, welcome to the Financial Survival Network.
Hi, how are you?
Great. So Detroit finally did the dastardly, the dirty deed. They filed. No surprises there. Effectively, Michael, you know and I know that the city of Detroit has been insolvent for many years. They've been pretty much exceeding their revenue by $100 million a year for the past 6 years at least. And finally, they just did what everybody knew they should have done a while ago. They went bankrupt. What was your take on it?
Absolutely. Long time coming. Ever since the early 90s, they were rated below investment grade if distressed by the ratings agencies. Last few years, it definitely accelerated. The filing did come as a little bit of a surprise when it did, which was last Thursday, just because we thought there would be more negotiations in the process. But they finally threw in the towel and said, we don't have the capacity to negotiate, and they're going to start imposing losses on all the bondholders. So we were a little bit shocked that happened when it did. However, the city has been distressed over the last 20 years, and the city is really a shadow of its former self. So this is a big deal in the muni market, definitely.
And Michael, you know, one thing that surprised me is that less than half the property owners in the city are paying taxes.
Absolutely. You hear stories about entire street blocks and one person just paying taxes. There was a woman who was writing about it, I think in the Wall Street Journal a few weeks ago. I can't recall. But you hear other stories. The city is 140 square miles. You could fit in New York and Boston into it, and yet it only has 8 ambulances. So it's a sad story. Services in the city are inadequate, and I think that's what the bankruptcy is going to seek to do, to bring the services in line with the current population needs. They're still paying expenses for services that were provided 20 years ago when the population was much greater because of their pension and other post-employment liabilities. Now that the population is 75% smaller, it doesn't really seem to make sense to do that. So what you're forced to do is to break these contracts, and that's what the Chapter 9 filing is going to do.
Well, I'm looking, Michael, at saying, you know, the whole concept of what a city does and the services that it provides, maybe it's time that should be completely rethought. And maybe the modern city shouldn't be a provider of services at all. Rather, it should be an intermediary and really arrange for services to be provided by third parties. So really, if you look at their school system, it's a joke. It's more of a training ground for future criminals. And maybe they should just be providing for third parties to provide those services, because they have some pretty decent universities in Michigan. And let the University of Michigan set up a school system and give them vouchers, pass out vouchers to the people with children of school age and let them go find somebody to educate their kids, because obviously the city of Detroit is completely unable to provide them. And when it comes to police services, highest murder rate, or certainly very close to the highest in the country. And basically the place has gone native when you get down to it. They really can't provide the most basic services. Maybe they're pretty good at, sending out the meat wagon, but they really aren't very good at providing any basic services, from street lights. Most of them are out. 40% of the street lights are out, to, like you said, ambulances. They've got 6 ambulances for that size city, and most of the ambulances have 250,000 miles or more on them. I mean, it's a failed city when you get down to it here, right, Michael?
There are some shortcomings. The city actually, it's interesting that you mentioned that there is a room for private service in this case, because I know a lot of the neighborhoods in the city, because the police service is very inadequate, have actually contracted private security forces as an alternative to the city-run police department. So the bankruptcy is just going to attempt to cut costs and make it so that they can increase the level of services provided to people in the country. And hopefully people will start coming in and repopulate the area, and maybe it'll become a better place than it is now. But urban blight is very significant there. They do have some assets that they could sell to raise money to pay off their creditors. If you look at the emergency manager's report for what he was planning to do in the next few years and how to restructure everything, one of the things he mentions is leasing assets like Joe Louis Arena, which is where the Red Wings play, although I'm not sure if the city of Detroit actually owns that arena. But a lot of the stuff they have actually has already been leased out or is already owned by the private sector, with the exception of, say, the Art Institute. But there are a lot of things that need to be done to bring Detroit back to solvency and make the city a better place. And it's going to be a very, very long process, multi-year process, I would say.
My concept, I thought, instead of having Mr. Orby, the emergency manager, if you ever saw that TV show Hardcore Pawn, I was in favor of bringing Les Gold on as the emergency manager, because I thought he had the negotiation skills required to bring all the parties in there. He could beat up the unions, the pension funds, all those people. One thing you mentioned was that the potential of getting the bankruptcy thrown out, which I don't think is ever going to happen. There was that local judge that ruled that the bankruptcy was illegal because it was going to roll back pension benefits. But the fact of the matter is, if they go along the way they are, those pension benefits will be rolled back anyway, because all of the pension funds are effectively insolvent and won't be able to pay out the promised benefits to retirees, which, unlike other states like California and New York, are not really paying out excessive retiree benefits to their members.
Yeah, you're right, and it is a problem. It needs to be addressed. I don't think enough has been done to address it. It's actually pretty interesting. If you look at the pension benefits in 2011, if you look at the value of the pension benefits, so the total value of future benefits that is carried on Detroit's bankruptcy, it was about, I want to say, for the pension benefits, $650 million in 2011. It inflated to $3.5 billion in 2013, prior to when they declared bankruptcy. So, in a sense, you don't really know what these pensions are actually worth in the first place, but you know that they're carrying the liabilities at an 8% discount rate. And an 8% discount rate in a 1 or 2% world isn't really realistic at all, actually. So it's an interesting process, and I think more attention has to be given to it, definitely.
Yeah, and, this is the thing, Michael, we had in Detroit, and I'm I'm not politically oriented here, but the fact is we had 50 plus years of socialist collectivist rule in Detroit, of trying all these fancy socialist programs, and this is what we wound up with: bankruptcy, insolvency. So obviously this is not the answer to what ails America's cities. And the fact is we've got dozens of other cities across the country that are following Detroit into the ash bin of the dustbin of history. They're ready to file, basically. They're equally insolvent. Some of them are in as bad or worse condition as Detroit. So something else has to be tried here. And when we get into the discussion of school systems, many other cities' school systems are failing just as badly as Detroit's, even if their finances aren't in as bad shape as Detroit's. So, we're going to just break right now for a sponsor announcement. But when we come back, I want to talk about the opportunities that these bankrupt cities have created by effectively scaring investors away from municipal bonds. This is Kerry Lutz on the FinancialSurvivalNetwork.com, 1230 WBZT.
Hi, it's Kerry Lutz. I recently decided to move my retirement account into physical precious metals to hedge against the coming times. If you want to move an existing retirement account into physical precious metals that you can hold in your hand, tax-free, there's no company that can do it more quickly and efficiently than Regal Assets. It took them just 24 hours to open my new IRA account, and all I had to do was fill out one simple form. The best part is that Regal Assets does all the work for you. They cover the setup and administrative costs for 2013. If you're interested in making the same move I did, call 855-678-6620, 855-678-6620. That's 855-678-6620, or visit them at regalassets.com. You'll be glad you did, and tell them Kerry sent you.
We are back on the Financial Survival Network. I'm Kerry Lutz, 1230 WBZT. We've got Michael Combs on, and we're talking about municipal bonds and the opportunities that have been created by the city of Detroit's filing for bankruptcy. Michael, so what kind of opportunities exist now because of the fear factor that has arisen from Detroit's filing?
Well, we're seeing a big sell-off in the municipal bond market ever since the filing. So bonds that were priced at 4.5% are now trading at around 4.9%. So I think the opportunity is there if you're selective and if you're cautious. So the best thing to do is to make sure that you understand the bond that you're buying and maybe seek expertise on the subject. So there are opportunities, but you have to be very careful.
And there are a lot of cities though that are in dire straits that are going to file, right?
We don't think they're going to file, and that is because filing is very much a last-ditch effort. You can miss a payment and not be forced into bankruptcy. So you can default on your debt as a city. You can reduce your obligations and negotiate with creditors and still not file for bankruptcy in the municipal space. That's totally different from the corporate space. In the municipal space, it's very much a voluntary filing. So that notwithstanding, we do think cities are going to be in distress. There are many cities that are in distress. You can look at the problems in California with a lot of the real estate exposure with certain cities. But as far as a system-wide increase in filings across the municipal bond market, it probably won't happen, although stresses could ensue. And we're taking advantage of some of the high yields right now, just to put money to work and take advantage of a lot of the higher yielding bonds out there.
So where are the safest places to be buying, to be looking now?
The safest places are in areas with a large and rising population growth. So if you look at cities like Houston, which are benefiting from the oil transportation through the hubs in Houston into places like China and abroad, those are thriving cities with strong institutional presences. If you look at cities in metropolitan areas, giving you just a couple of towns, you can look at Milburn, New Jersey, for example, which is where we're both from. That has AAA credit rating by S&P. You have a strong residential component that is locked in because of its vicinity to New York City. So you have high income levels, which are also very important, strong real estate values, because the real estate values are ultimately what tax revenue is derived from, property tax revenue. So you want to make sure that the population growth is steady and increasing. You want to make sure the real estate markets are healthy, that income levels are high, and that unemployment is low. Those are the main things we look at when investing in municipal bonds of cities.
And then I would say you've also got these areas I would call refuge states, people fleeing from high tax areas in the Northeast and these dying cities. So they're moving to places like Florida, Palm Beach County, Texas, moving out of California, right? So these are population growth areas, right? That happening also?
There are areas, definitely there are areas in California, given its high tax situation. People who aren't anchored to California are moving to places like Nevada. And at the same token, if you look at the vote for the tax increases in the 2012 election, Proposition 30 in California, the people who voted most highly for the increase in taxes were the people in wealthy areas, such as Marin County, which is in the Silicon Valley area. But those people that don't need to stay in Silicon Valley, for example, those in the Inland Empire area near Los Angeles, about an hour away, they could easily just set up shop at places, low tax places like Las Vegas or New Mexico. So I would say that is a driving factor, especially with people whose tax bills are very high, and it's definitely something to watch, absolutely.
And then, of course, looking at also North Dakota with the continuing shale oil boom going on there, right?
Sure, and especially places like North Dakota tends to have less population, so there isn't much in terms to choose as far as municipal bonds, even though places like Williston, North Dakota have negative unemployment, if you can believe that.
Yeah.
But if you look at places, say, along other shale formations, for example, the Marcellus Shale, which is in the sort of Ohio, Pennsylvania, western Pennsylvania, eastern Ohio region, that's revamping a lot of areas that had exposure to a lot of the U.S. auto manufacturing, shut down Chrysler plants, things like that. That place, you can't drive through there without seeing new oil wells. So those are a lot of places to look that may have been distressed, I'd say about 5 to 10 years ago, and are now on the up. So those are areas where you can find higher yields and higher property taxes because it's more jobs in the area. We would definitely look to buy bonds like that, absolutely.
So there are opportunities, but not what you would call traditional opportunities. They're kind of like these indirect opportunities, if you will.
Sure, there's that, and those are just from a let's know what's paying these bonds perspective. Let's look at the actual underlying credit quality. Those are some big opportunities, but I would say the market in general, you're looking at yields that are higher than actual taxable yields. So think about it. A tax-exempt bond that you pay no taxes on can give you more return, more money every year than a bond that is being taxed, more income on an after-tax basis. So we like those opportunities at yields at around 5.5%. That's like saying I'm getting a yield of 9% if this bond were taxed. So the muni market is filled with opportunities right now, and we're definitely constructive and look to put money to work. Very, very opportunistic here, absolutely.
Well, sounds interesting. So, Michael, people want to find out more about you, more about Cumberland. How did they contact you? How did they find the company?
Great. Our website is www.cumber.com. That's C-U-M as in Michael, B as in boy, E as in Edward, R.com. And you can look up our contact information on the website.
Oh, excellent. Hey, we appreciate your coming on the Financial Survival Network. And you can always find out more on financialsurvivalnetwork.com. We've got some great reports coming out. And Michael, we'll look forward to having you on again soon. And yeah, hey, everything isn't always bleak as it's often pointed out and painted to be. So we'll talk with you again soon. You be well, Michael.
Absolutely. Thank you very much.
The show is brought to you by Audible. If you want to listen to it, Audible has it. Would you believe they've got over 100,000 titles in virtually every genre you can think of? And don't forget, you'll get a free audiobook and 30-day trial just for signing up today at audiblepodcast.com/Lutz. That's audiblepodcast.com/LUTZ. Hey, if you're a coffee connoisseur like me, you need to try an amazing new roaster out of L.A., Tonks Coffee. These guys are fanatical about delivering the best beans in the world. They source directly from the growers, roast it, and ship it to you within 24 hours, so it's the most fresh coffee you've ever tasted. Every 2 weeks, you get a new batch of incredible beans roasted to perfection. If you're hitting a cafe most mornings, this is a much better and more economical way to get great coffee. Tonks is by subscription only, and they're offering you a free sample. Use the URL tonks.org/liberty. That's TONX.org/liberty. Get some for yourself or send it to someone you know who appreciates the finer things. Tonks.org/liberty. Again, TONX.org/liberty.
The Financial Survival Network, helping you to survive and thrive in the new economy. Get our complimentary newsletter at financialsurvivalnetwork.com. This is the Financial Survival Network.